Before I get into things, I'm sure most of you know what a REIT and dividend stock already are, but just in case you might not, you might be new to these things, let me break it down quickly in 20 seconds. So a REIT stands for a real estate investment trust, and basically is a trust fund that invests your money into a portfolio of real estate properties that collects rental income. It then pays the majority of this income received out to shareholders in the form of distributions, which are pretty much like dividends. A dividend stock is obviously an exchange-traded security that represents ownership of a company. These are usually companies that pay out a percentage of their earnings every year to shareholders in the form of dividends as a form of return on your investment. So in terms of the structure of this comparison, like I said in the intro, I'll break it down into different categories and we'll talk about which option has the edge in each. The 5 categories I use in this video will be dividends, frequency of returns, share price appreciation, risks, as well as the tax implications, which is very important. So the first category I'll start with, of course, is the dividends themselves. So in terms of dividends, there's one important thing to note about REITs that makes them incredibly unique. First, they're referred to as distributions, but I'll call them dividends for the sake of this video to avoid confusion. Some REITs actually do pay out dividends but for the most part they pay distributions. There are tax differences actually between distributions and dividends in Canada, and I'll get into that a little bit later on. But the important thing to know here for REITs is that for REITs listed out of the US, to be considered a REIT, you legally are required to pay out a bare minimum of 90% of your taxable income in the form of dividends. Canadian REITs don't have the same hard 90% minimum requirement, but they face pressure from shareholders to generally pay out close to this range, if not within this range. Therefore, because of this requirement or pressure, the dividend yields that REITs pay typically are higher than dividend stocks because they either have to due to legal restrictions or they face significant pressure from shareholders to pay out a higher percentage of their taxable income. However, because of these restrictions or pressures, there is a significant problem that REITs could potentially incur in the future. In times of financial hardship, some REITs may be likelier to cut their dividend than other dividend stocks. But during these times, nothing's really safe, therefore it's not really an isolated disadvantage that is strictly related to REITs, but it is something to be aware of. So with REITs, the threat of dividend cuts may be slightly higher. So in terms of dividends, I have to give the edge to REITs, just because on average they do generally tend to pay higher dividends. We'll get into some of the other issues surrounding these dividends, such as taxes, a little later on in the video. The next factor we'll compare both on is the frequency of returns. Kind of following under the same topic of dividends, the next thing I'll compare them on is the frequency of the dividends. Typically, REITs will pay out their dividends monthly. This obviously provides tons of benefits in itself, as I've talked about in multiple videos already. But for example, if you're using this income to help supplement monthly bills, it makes sense to receive this income monthly. And if you're using this income to reinvest, you're better positioned to capitalize off deals in the market if you're receiving this income monthly rather than quarterly. Dividend stocks typically pay their dividends out quarterly, but there are some companies that actually pay it out monthly. If you want to see some of those stocks, go check out that video I did on monthly dividend paying stocks. But all in all, the clear advantage for frequency of returns here has to go to REITs due to the higher tendency to pay monthly distributions rather than quarterly. The next factor I'll be comparing the two on is share price appreciation. So in terms of share price appreciation and growth of the stocks, there's one important thing to keep in mind with REITs, and it's requiring this 90% requirement or pressure for them to pay out of their taxable income that we just talked about earlier. Since REITs have restricted amounts of income that they're actually able to reinvest into their company, this one means they're not able to invest this money into growing, which adds one constraint to the share price appreciation, but this also creates another problem. To actually be able to raise capital to expand, REITs are pretty much forced into taking on debt or issuing shares. Therefore, share dilution is common amongst REITs, and having common shares outstanding actually increase annually is fairly common, where with dividend paying stocks, you tend to see these shares decrease. This share dilution and issuing of new shares obviously puts downward pressure on the share price as supply is increased, diluting the value of the shares that you own. This is a second factor that actually holds back the capital appreciation of REIT share prices over time as well. Because dividend paying stocks don't typically have the same restrictions or pressures, they're able to reinvest significantly more of their earnings back into their business. This means that over the long run, there is a much greater opportunity for growth with these companies, and this is why you typically tend to see higher share price appreciation with dividend stocks over time than you do with REITs. So for share price appreciation, kind of a no-brainer here, but I've got to give it to dividend stocks. So now that is 2-1 for REITs. Let's see if dividends can catch up. The next category we'll compare them based on is risks. Which of these options presents you with a better ability to mitigate against risk? So dividend stocks allow for a lot of potential for diversification as you can buy dividend paying stocks across multiple industries. For example, there are high dividend paying stocks in the financial industry, the food and beverage industry, the energy industry, telecommunications industry. The list just goes on. By spreading out out your stocks across multiple diverse industries, you're able to diversify your exposure extremely well, balancing out the lows of one sector with the highs of another. This results in a lower risk portfolio. For REITs specifically, REITs can be diversified throughout multiple property types. For example, there are REITs composed mainly of office buildings, some with residential properties and apartments, and others that invest into commercial plazas and commercial locations. So this allows you to diversify and balance out your exposure between types of real estate properties, like I said earlier. For example, in times where stores might be closing down due to, say, a pandemic or offices downsizing, your risk can be mitigated by holding, say, residential REITs as well. However, one thing to note as well is that while you may be diversifying your exposure to property types, they are still all tied into the general real estate market at the end of the day. Things such as property taxes, interest rates, property prices affect all types of real estate to an extent. So in terms of risk, I would have to give the edge here to dividend stocks just because of this greater range of diversification that you're able to achieve by spreading out your investments throughout multiple industries, especially in a time where, interest rates are potentially going to increase and property values are at all-time highs. However, I think it is worth noting that in terms of diversification, this was assuming that you're going with one or the other for this dividend portfolio. I think that if you have an existing portfolio of stocks that's well diversed, adding REITs can provide incredible diversification because you're exposing yourself to a completely different market that has very little correlation with the stock market in general. But also, as I mentioned earlier, I think there are also great options for diversification with dividend stocks, which is why I still have to give the edge here to dividend stocks. So now we're all tied up going into the final inning. The next and last factor we'll be comparing the two based on is taxes. I think it's also very important that we consider these tax implications for both options here, because this can make an incredible difference for some people. So eligible dividends received from Canadian corporations are subject to the preferred Canadian dividend tax rate. The distributions that REITs pay out, on the other hand, are not subject to the same rate and are treated as ordinary income for tax purposes. Obviously, each province has different provincial rates, but in terms of federal rates, ordinary income is taxed at 33% for the highest income tax bracket, whereas eligible dividends are taxed at 25% and ineligible dividends are taxed at 28%. When you factor in the provincial rates here, the difference becomes even greater. For example, ordinary income in Ontario at the highest tax bracket would be completely taxed at 54%, whereas eligible dividend income is taxed at 39% and ineligible dividend income is taxed at 48%. Now, obviously, these are the rates charged at the highest tax bracket in Canada, which I'd assume a lot of people watching this video, myself included, are well underneath, but it does do a good job at highlighting the differences in taxes and just how dramatic it can be. There are tremendous benefits to receiving dividend income over ordinary income. So there's obviously a pretty big difference here between the income you receive from REITs and that of dividends when it comes to taxes, and there is clearly a tax benefit to owning Canadian dividend-paying stocks over most REITs. However, if you are in Canada, there are some ways that you can avoid this disadvantage when it comes to taxes. All Canadians over the age of 18 have access to a TFSA, which provides a tax shield for any income or capital appreciation on the assets held within it. So if you bought REITs and dividends in your TFSA, these tax differences will be completely irrelevant. However, some people watching this video may have already maxed out their TFSA contribution room for the year, or, are inclined to save this room for, maybe their higher growth long-term investments. And for those people, when it comes to taxes, this matters, and dividend stocks are the clear winner. So that about wraps things up for this comparison. This might make a couple people upset here looking for a clear one or the other answer, but the truth is that I don't think there actually is a clear-cut winner here. But for the sake of this video and my personal preferences, because the score was 3-2, I will declare the winner to be dividend stocks. Just because the potential for compounding gains with the share price appreciation, plus the dividend income coming in, and the ability to diversify over multiple industries, and the tax advantages. But like I was saying, the truth is it really depends on everyone's personal situation. You might be buying these stocks strictly for passive income. In that case, REITs might make more sense for you. You also may be buying these in a TFSA or any other registered account, so the tax advantages of dividend stocks would be completely irrelevant for you, and therefore you might prefer the higher dividend payouts that REITs provide. Therefore, like I said, it's an answer that depends on you, your preferences, and